Our next topic is all about risk management, and joining us to discuss this are our panel of guests. Let's start with introducing you to all of them. David is closest to me. He's a partner at DB Risk and Compliance Services. Also with us is Tom. He's the SVP, Head of Business Risk for Wells Fargo Global Financial Institutions. Freya is the General Counsel and General Manager Compliance International and Institutional Banking at ANZ. And Henrik is the Global Head of Financial Anti-Crime at Nordea Bank. Thanks very much to all of you for joining us. This is going to happen, this session this afternoon at 2 o'clock, conference room 1 I have here. You're going to be the moderator. Put these guys through their paces. This is a sneak peek, everybody. What do we plan to ask these guys, and what are some of the main things you'd like to see come up?
Well, I think firstly, I'm really privileged that I've actually got a panel of practitioners who've been there, warts and all, for a number of years. They've had the rough side of regulation. That will be a major topic, what impact regulation has on our systems and controls. We're going to be looking, I hope, at where some institutions have gone wrong, what can we learn from them, what are the possibly unintended consequences of regulation on a global basis. Because there is evidence that some firms are actually de-risking. In other words, they're simply excluding themselves from a market, which I think is quite a serious development. And we're looking at how best we can service our customers by compliance officers and money laundering officers being part of the senior management team, which is actually encouraging good value-based business. We're not there to stop business, we're there to facilitate business of a kind which actually works. And the financial crime agenda is so wide these days, not all of it is risk-based, so I think we have a major challenge on our hands to explain to our colleagues how we're all addressing those issues.
How are you guys addressing those issues then?
Oh, that's a good question. Well, I think one of the major factors that we're trying to understand is how do we balance the regulatory scrutiny and the things that we must do in order to comply with the laws and regulations that only increase with the challenges in the marketplace of an ever-expanding world becoming smaller and smaller.
So give me some examples, Tom.
No, a good example is recently some banks have announced that they're getting out of certain payment products, cash letter, and how do other institutions pick up that business in a proper way that isn't going to get them in further trouble with the regulators, but also manage the rest of their portfolio and continue to be seen as an institution that understands how to control their business.
Freya?
I think also as well, what we need to do is sort of bring the firms along with us. The amount of regulation we have is putting a different type of accountability on our boards and our business as a whole, and making sure, if we look at the KYC procedures that we have and the regulation that's increasing around those, and how we run our relationships and what type of clients that we have, it all goes to David's point about de-risking and certain people taking the option not to get to know their clients but just immediately to exit those or not take part in that particular marketplace. And we're seeing examples of that across the board. We have had a lot more focus around culture as well as the risk profile emerges, and how do we judge culture, and one of those EQ soft things I think the board are struggling with. Certainly from an Australian perspective, our regulators are already on a prudential basis encouraging us to think about culture, and that will encourage de-risking behaviour. And we're not entirely sure that's really where the regulators have thought they wish to push that type of activity. I think from our perspective, we'd like to see that activity absolutely regulated and controlled, and the banks having a knowledge of it rather than it perhaps moving back underground.
And I think what we have discussed already in this panel prior to this session here is the entire cost-benefit aspect of what we're talking about. The de-risking is, of course, lowering the risk in total, but also, you know, the cost of the operation that we're talking about here, and not least, of course, the risk and the cost associated with the fines. I think that will be an interesting topic also to address today. We see the fines soaring and in all parts of the world, and that will be an important topic for us.
Yeah, to follow on to that, I think one of the interesting things is that over the last 3 years, most major banks at this point have a regulatory enforcement action of one sort or another. And as Henrik said, the fines have gone up and up and up. And at what point do the financial institutions themselves have to evaluate that cost-benefit analysis of how we maintain a program, maintain our customer base, and manage the regulatory scrutiny that we're
But
under.
I think that takes away risk analysis because you're moving from risk acceptance to zero tolerance. So is there any opportunity to actually assess a risk if really your answer to that question is not to do it at all?
Right.
Yeah, I think one of the other aspects that we might want to come into as well and be a little controversial.
We love controversial here on Sibos TV.
Well, given announcements earlier in the week that some of the larger institutions are trying to form what they call a utility on the age-old question of KYC, or know your customer. Well, I'm old enough and ugly enough to know that KYC is a fundamental banking concept. It's not rocket science and it's not new. But how you do it to the satisfaction of a regulator is quite a different order of difficulty. I'm rather skeptical, I have to say, that these so-called utilities are actually going to cut the mustard. But I'm hoping we can get some feedback from the floor on that.
However, as we discussed, of course, these utilities, that might be the silver bullet of the discussion here, balancing the cost and the risk and benefit aspect of this. However, of course, I do agree the KYC is maybe not where we should start, but more in the sanction area or the AML, whether there are some silver bullets out there to be found for all of us.
I think one of the things that we face, having a footprint in 34 countries and like yourself, vastly global, is how the regulators are seemingly collaborative but never actually come together to answer this question as one. So we have a multitude of privacy legislation across the footprint. We also have a multitude of regulation about the types of documents we're required to collect for KYC. And I think that the utility to that respect may actually be able to monitor the collection of documents, but it doesn't go so far enough to know that client in the manner that all the banks to date have been undertaking their relationships.
Yeah, no, I agree. And the other side of that is that the correspondent banking internationally and the products that we're now able to offer, it's really a relationship business. It's not just about the relationship team going out and selling. It's about building a full relationship. And at this point, in where we are in the cycle, the regulatory side, the risk management side, is a big part of that relationship building and understanding. So to outsource that would lose a large percentage of what we're responsible for.
Yeah, I wouldn't want to get all of this out of perspective either, because the one big word we haven't yet mentioned on this interview is the T word, terrorism. And I think any system of utility has got to account for that, because terrorist finance is qualitatively different from AML, which is usually the dispersal, acquisition, use, possession of criminal property. Terrorism is often dealing with funds that are actually donated because they believe in the cause, whether it's animal rights, certain jurisdictions known to sponsor state terrorism. It's actually with a policy in mind. And I think no system, no utility should ignore that aspect. Coming from a European jurisdiction, probably we know that better than anybody else, having had a number of issues of that kind. So we're not going to ignore that either, I hope, this afternoon.
The other two T words I would bring up are talent and technology. So let's start with talent first of all, because risk management was something a few years ago you didn't really recruit a lot of people in the business for, but it's growing at a phenomenal rate. Is there a talent gap in this industry?
Absolutely. The reality is that the recruiting efforts that are happening around the world are aggressive, and people, the pool of people that are really talented enough to do the work today is small. And so we need to continue to train the next generation of people to manage risk, to manage AML, to manage sanctions, terrorism financing, and we're not there yet. So you see people moving from firm to firm, and it's the same people over and over, and eventually we have to get to a place where we're bringing in new talent.
I would totally agree with that. I think the war on talent will be back. It used to be on frontline people, and I think now it's moved to more of what we call the support or the enablement groups of people around risk management, whether that includes compliance people or specified professionals.
Give me some of the job titles of some of the people that we need this talent.
So where we find a gap is all around our MLROs, so there's money laundering reporting officers, talent, particularly, as I said, we operate in 34 countries, trying to find them locally talented talent, a local talent pool, particularly in some of our areas in Asia and the Pacific, is a lot harder than actually finding them perhaps in the US or the UK, where the speed of the risk management has actually grown from maybe 15 years ago, whereas it's still relatively new in some of those regions. So those type of titles are hard to come by. General compliance officers who are experienced either in fraud or fraud risk are also people that are up and coming but haven't been around for a long time in those siloed channels, and we're looking now in terms of those types of people to come from different professions. So we look at people who've actually come out of the police force, whether for their investigatory skills or certain other types of areas for that. So we're not actually looking at the financial services as a finite bucket. We're now looking outside for certain skill sets.
Yeah, and coming from the Nordic region, which is normally highly educated, I'll also say I share the same experience. It's a very, very limited pool of people. So I would say my last colleagues coming in, they are either US or UK background. So we pull them in from abroad to gain the experience, and in the other end also taking graduates directly from school who we can kind of grow up in this area and who are fast learners. But it is exactly the same. The talent gap is out there, and it's very relevant. And
one of the other points is that one of the areas in the world that's under enhanced scrutiny is Latin America, and Latin America is one of the places where it's hardest to find talent, which there's a major gap there.
I think really where the biggest constraint is actually the fact that in our kind of operational risk management, you do need people who have experience, whether it's in law enforcement or other parts of the business. And that does not mean necessarily that you can get a graduate and put them straight into a role of this nature. You really do have to know the business, have dealt with problems, and have a fairly wide background. And I would like to see more firms actually laying down a rule for appraisals and human resource management that nobody gets to top management without going through audit or compliance or risk management. That way you would hopefully engage more senior management, because I think the financial crisis has taught us, certainly in the UK, one big lesson that we do have a senior management gap. They weren't engaged enough. Nobody was asking the right questions on boards. Non-executive directors, of which I'm one on a small bank, were not challenging. They were merely acquiescing in what was going on. And I think that is, we do have to have people on our boards that will ask the difficult questions from a loyal point of view, but challenge, not acquiesce.
Okay, well, unfortunately, we've got to leave it there. Thanks to all of you for giving us your time on Sibos TV.